Let me start by saying what a great pleasure it is for me to moderate this panel discussion on the potential for technology to address heightened climate change risks. I would be guilty of a gross understatement if I were to say that the challenges of climate change are very much on all our minds. And the international community is in many different fora working hard to respond to the challenges posed by climate change. And a great deal of work is being done in the financial sector, as Fernando has already pointed out. New investment vehicles like green bonds are growing in importance. And central banks and financial supervisors are focused on the disclosure of climate-related data by financial institutions and corporations to the relevant authorities and to the public. These efforts seek to ensure that market participants have the information they need to make investment decisions related to particular companies or products. And they involve different types of disclosure. The disclosure of the climate risks these institutions face themselves, the disclosure of the damage environmentally their own businesses may be doing or causing, and the risks of greenwashing, where environmental benefits of particular products and investments may be misrepresented to the public. International bodies such as the Financial Stability Board, the NGFS, IOSCO, and ESMA are all active in this field. But what can technology do to support these efforts? And how can we ensure that technology does not actually harm the environment? To point out an example of this latter point, we're all aware of the enormous amount of power used by proof-of-work validation mechanisms in distributed ledgers like the Bitcoin blockchain. We have two key projects in the hub, Project Genesis in the Hong Kong Center and Gaia in the Eurosystem Center, that are designed to support efforts to combat climate change. To discuss these issues, we have assembled a very distinguished panel of experts. And we're very privileged to be joined by Mr. Eddie Yu, to my far left, Chief Executive of the Hong Kong Monetary Authority, and in which capacity he's led major initiatives in the area of technological innovation with a particular focus on environmental sustainability. We have Eric Thedin, Governor of the Sveriges Riksbank, who prior to his appointment as governor in January, served as Director General of the Swedish Financial Supervisory Authority. He's also held several positions in international organizations, including as Vice Chair of the European Securities and Markets Authority, ESMA, and as Chair of IOSCO's Task Force on Sustainability. Welcome. And finally, Mr. Stefan Flückiger, Deputy State Secretary for International Finance in Switzerland, where he heads the Planning and Strategy Division, acts as Switzerland's Finance Deputy to the G20, and also has coordinated the digital and sustainable finance strategy of the Swiss government. I'd like to ask our distinguished panelists 2 rounds of questions, after which, time permitting, we'll open the floor to the audience to ask questions. So Eric, I'd like to start with you, if I may. In recent years, many jurisdictions have taken steps to introduce climate disclosures. And a great deal of attention is being focused on those disclosures by authorities who monitor and regulate institutions, by investors who make investment decisions on that basis, and by the more general public. And I wonder if you could share with us your view as to what degree these regulatory climate disclosures are really fit for purpose. Are they giving these various groups of stakeholders the information they need in order to make reasoned and well-informed decisions? And finally, how can technological innovation, or can it, help in this process, particularly for the firms in preparing these disclosures and for other stakeholders in actually using them?
No, thank you, Russ, and thank you for having me. And I will take you back 4 years ago to a global meeting we had in Stockholm in my role as heading the Task Force on Sustainable Finance within IOSCO. And one of the themes was disclosures. And one thing that I remember from that meeting was alphabetic soup. There were so many different private disclosure standards or not standards that was around, and a lot of the investors were saying, that's fine, we have something to grow from, but for sure this is not standardized, it's not harmonized, it's not comparable, and for sure it's not mandatory. So I think that was the starting point, and the good with that meeting was that there was a lot of relevant people in the room. And that was also the starting point for IOSCO's drive to push the organizations like the IFRS to actually go into this. Many of the international organizations were lagging when it comes to taking initiatives in the climate change or climate risk area. I think that's true for the Basel committee, that's true for IOSCO, and that's also true for maybe BIS, I don't know. So I think IOSCO tried to step forward, and also IFRS was lagging and behind the curve, and also they were stepping forward. So fast forward 4 or 5 years, we're now in a much better situation. The ISSB, which is one of the arms then of the IFRS, I've now consulted on a standard for climate-related disclosures. And according to what I hear, that will be published in mid 23, and then it's some kind of endorsement process by IOSCO, so basically a quality stamp by the regulators, and that will pave the way for having this as a standard, a global baseline from the 1st of January 24. So hopefully then, and then coming back to technology, if there's a lot of fancy technology out there, and I was really actually impressed by the presentation by Gaia this morning, but it's like this expression, shit in, shit out. If you don't have good data, well, you have fancy machines, still going to be something that is not valuable. I think that was the alphabetic soup kind of starting point. Now, hopefully, we will have reliable and also comparable data. Also, and maybe as important, there is a lot of initiatives going on in the various jurisdictions. So the global baseline hopefully will be the ISSB standard. And I should also, of course, mention TCFD because they were kind of paving the way for the ISSB. US through the SEC are also presenting their standard. And of course, a much more ambitious standard is also being presented by the EU Commission, or basically will probably be out there very, very soon. And I know there's also initiatives going on in Asia, both in Japan and in China. So there's a lot of difference. So you could actually end up in a alphabetic soup, but from different jurisdictions rather than for private initiatives. I hope that the global baseline ISSB and also, of course, the ongoing dialogue through with the different jurisdictions that is ongoing, that there actually will be a fairly harmonized approach to this. So this takes me to the role of technology. And again, coming back to the presentation by Gaia, there will be so much data out there. And also if you include the kind of text analysis that was also presented here, I think there will be a role for tech to actually analyze and present and to make use of the data. So it's not only an annual report that will be read by several equity analysts. You need much more kind of compounding data and analyzing data from various sources. And this also includes weather data. It includes geographical data for physical risks, for example. So it's not only data maybe that comes from these reports. So I think what the regulators and what IFRS is trying to do, ISSB is trying to do, is having kind of a base of reliable data to build upon. But for sure, technology will be extremely important in that.
Thank you very much. I think your remarks point to the need to have adequate taxonomies that we can then more effectively classify different types of financial risks presented by climate, and more generally just to have a more useful analytical framework. And I know that Switzerland has been a great proponent of this. for the introduction of climate respectful and sustainable classifications of financial investments. And I'd like to ask Stefan, what role can technology play in developing taxonomies and classification of financial assets? And how can they be used do you see a role for technology in actually facilitating monitoring them, reassessing, assessing them, and also reassessing the taxonomy itself?
Thank you, Ross, and thank you very much for the invitation. I should perhaps start by saying I'm humbled always when I come here to Basel as a government official in these holy halls of the central bankers. The State Secretariat for International Finance, the small unit I work in Bern, is a child of the financial crisis, and for the past 10 years we worked on basically clearing up all the follow-up on the banking secrecy stuff and the stability stuff. And we had 2 years ago a restart when we thought all these problems are now solved, and established a strategy which basically focused exclusively on the digital and the sustainable stuff, because we really believe that going forward this will be the main occupations that will be out there for the financial industry as a whole, but in particular also for Switzerland. Now, we got sidetracked, as I said a little bit last week and a little bit before that already, which is the reason also that Daniela cannot be here and is impacting a little bit on the diversity of this panel. But to come back to your question, we are a little bit critical on the taxonomy approach, because if you look at it, you want to cover the whole economy. But if you start with the taxonomy of what is good, what is bad, basically what you're saying is you're not targeting those who actually have the highest potential, the highest emitters. So in our approach, and I'll come to that, we say, okay, we have to be more flexible, so we also get to those, I'm talking about cement and steel and all those, which will always be there, but which we want to guide on their way to more sustainable activities. So a taxonomy does not cover that. And I think, on these panels, I'm not sure who of you has actually had the pleasure or the pain to look at the EU taxonomy. Just to give you an example, and a colleague of mine gave this to me, and this is real. The companies need to check the rolling resistance coefficients of the tire labels of their car fleet. And I'm not going into the details what happens in the winter when you have to change that. So if you go down into those monster requirements, then I think we really have to be careful that we don't get lost into the reporting challenges of the real economy. The Swiss approach, we try to be more flexible, focusing on transparency and international standards. There are basically 3 players in this game. You have the real economy, you have the financial institutions, and then you have the financial products. On the real economy, we moved early and made the TCFD standards that were mentioned compulsory as part of their reporting requirements for all large companies in Switzerland. So this is already there. And on the financial institutions, we urged all players to join the net zero alliances in the context of defense, and the large majority of the financial institutions are part of that. So that we're moving into sort of a coordinated, not only in the Swiss context, but in the international context, TCFD, defense, net zero alliances, in a coordinated way. Now on the product level, and you may have heard about this Swiss climate scores. What we tried to do first was sort of for the product level on some portfolio or fund that you can put a sticker like on the fridge, red, green, orange. We realized that this would not do enough in terms of the of differentiating really the problem. It would have been too much of a simplification. So the compromise we found is a bundle of indicators which include the carbon footprint, the carbon intensity, which include the exposure to fossil fuels, and also the engagement of the financial institution with the economies, with the companies that make up the portfolio of a given fund. So we had a wonderful response in Switzerland, and we're trying to promote it internationally and in the fora where we are active on a more global level. On the role of technology, what are we talking about? We're talking about transparency, comparability, accessibility, readability, the user friendliness. So this is basically just a playing field for the fintech industry. And we found, in Switzerland, what is going probably like in other countries too. We had a real cultural change in the landscape. The fintech landscape in Switzerland is now made of the academics and the NGOs and the IT nerds, and then mostly ex-bankers. Not so many bankers, but mostly ex-bankers. They're dressed differently, they think differently. So it's really also a cultural change, and we see that in many of the discussions that we have. Which are not quite easy with the incumbent financial industry. One of the game changers, we believe, will be the net zero data public utility that was where we were in the steering committee with some of the large players like France, UK, the ISSBs in there, many of the relevant sustainable financial organizations are in there, because there we're set. I look at it like a great server where the different measurements will be put in there, and where everybody can access it. The fintech can access it, and you can then start to sort it out and make sense out of these data. So technology, I think, like Eric said, will be a great, if not the only way to go forward in this time where basically data is the new gold. And I don't see any other way than approaching this with fintechs. And we're looking at, especially also at AI, as a means to go to that. By the way, and I want to close with that, there's some of you may know it, the Point Zero Forum that will take place June 26 to 28. The BIS Innovation Hub is part of it, where we will talk about all of these things in Zurich at that time. So much for this.
Thank you very much, Stefan. And Eddie, maybe this is a good way of transitioning now to central banks. It's been almost 3 years since the HGMA introduced a number of key measures on sustainable banking and green finance that were designed to really facilitate and promote Hong Kong's green finance development. Based on your experience, what lessons have you learned about the ways in which central banks can be using technological innovation to facilitate the green transition?
Well, thanks, Ross. You're right. In the last, actually 3-4 years, we did a lot on a range of different initiatives, from disclosure standards, stress tests for banks, to developing a very vibrant green bond market, that's been growing in size by 7 times in the last 2 years, just 2 years. And also creating an ecosystem and infrastructure for green finance to reserve management, green sustainable investment. But what I would like to talk about today is a specific project that we launched just last month, and a few lessons that we learned through that project. And it was the tokenized green bond that we issue for the government. And it is actually the first government issuer for tokenized green bond. And there are a few lessons that we learned from that exercise. First is that in financial innovation, we thought that think big, but start small is actually quite important in order for you to make a real impact. And it's always great or important to really push the boundary and be as creative as you can be. But when it gets to actual implementation using live transaction, you've got to be pragmatic. Let me get back a little on the background for the tokenized green bond. The whole journey started around 2 years ago with an ambitious project that we did together with the BI's Innovation Hub that Ross, you mentioned earlier. It's Project Genesis. And there we were doing a proof of concept for the issuance of tokenized retail green bond in Hong Kong. And it's got very innovative features like individual wallets for investors and also tracking environmental impact in real time. It's an ideal type of prototype, extremely creative, and by that, Project Genesis has generated a lot of interest from industry and also issuers, and really get them to think about it. But then the next step that we did was to think about, hey, should we get it into the real world? So our next step is to try to think about a real-life issuance using the prototype. By having the whole tokenized green bond cycle issuance with the full life cycle from issuance to trading to paying coupons to redemption, all done on a blockchain framework network. And again, this is the first one that's done by a government issuer. It was done by 1 or 2 commercial banks, 1 multilateral, but that's about all. These are all very small pilots. But when it comes to real money transaction, and when we are confronted with quite a complex project, eventually we decided to start small in order to make sure that it's successful with an issuance mainly targeting at institutional investor. But through that, we can still test out the whole efficiency gains and also of the tokenization technology, which is a lot. Typically, for a bond settlement cycle, you're talking about 5 days. For this one, we cut it down to 1. In fact, it can be cut down to seconds, if not for the funding practice of the industry. And we can also test out whether our own regulatory and also legal regime can deal with it. While we can avoid some of the operational risks, when you think about retail tokenized green bond issuing to the retail public through intermediaries, many of them are actually not quite ready for that because it's a blockchain new technology. And that issuance is a small one, $800 million US, but it was a great success. All smooth, and we proved that it can be done, and the efficiency is a lot better. And it, again, drew a lot of interest, not only from the intermediaries and the tech people, but also from issuers. They want to do theirs as well, and that actually serves our purpose, because what we want to do is to be the first one, but catalyze others to think about doing things that are similar. And the second lesson that we learned through that project is a cliche, but the importance of public-private partnership is extremely important. You know it all. For the government, we offer the credibility, we offer the reach, but for the private sector, they offer the technology, the agility, and also the expertise and speed. So it's very complementary. And in fact, we in this tokenized green bond issuance, we decided not to use a public blockchain, unlike the issuance of one other multilateral, because their issuance went into the problem of confronting with the issues like gas fees if you use Ethereum, where the gas fees are going, will there be compliance issue? So we actually opt for a private blockchain operated and built by a commercial bank. It's a private blockchain. But to support settlement, we decided that the HKMA, as the public sector, should issue cash tokens to support the settlement, which is done all on-chain, instead of relying on other on-chain tokens like stablecoins, which will impose credit and counterparty risk. So we did that, basically wholesale CBDC, to support the issuance of that first tokenized green bond. And it really goes very well. The investor have confidence because it's underlined by the CBDC Payment Foundation. And the initial issuance that we will have will adopt similar approach. It will still be public-private, but it's likely this time that we will use another private blockchain. Because we also want to explore, now there are several different private blockchains in the market. We also want to explore whether we could encourage some of these blockchains to be more interoperable. So we might use another private blockchain, but engage the first one and explore interoperability between some of these private blockchains. The third observation that we have is that technology, again, is also true for many other projects. Technological issues are actually relatively easier to solve. But for other non-technology, like policy, regulatory, legal issues, these are more difficult. Same for the tokenized green bond. At one point, we thought about real-time tracking of environmental impact. Technology-wise, it's not difficult. In the new energy plants, for example, you've got sensors, you've got IoT, and it's not difficult to put them on-chain for information dissemination. But think about if you were the operator of any of these projects. If once you put all the real-time impact onto the public blockchain for the retail green bond, basically all the output that you have will be under public scrutiny. Will all the project owners be comfortable with that? If there should be any, if the impact is falling short of expectations, who should be accountable? Things like that. So there's still quite a lot of these policy organizational issues that we will need to think about. But we will continue with that effort down that path. And down the road, we're quite certain that we will reach somewhere that we might be able to issue a retail green bond to both public investors and SMEs. But that will actually involve a long road. You're talking about potentially a direct reach disintermediation of some of the current arrangements. You're talking about potentially private wallets operated on a blockchain, handled or carried by different investors. You're talking about direct dissemination of information. That's actually quite different from the conventional model that we see. So I think it will take a while for us to sort out all the legal, regulatory, and other organizational issues before we can get there. But we will try to do that step by step.
Thank you very much, Eddie. I'd like to turn now to another aspect of climate change that I think is very much on the minds of central bankers, which is the potential risk to financial stability that climate change may engender. I think it's an understatement to say that a central banker's world is nothing if it's not complex these days. And there are many different forces now that are creating challenges for central bankers to fulfill their mandates. But one, of course, is the potential risks to financial stability created by climate change. And I'd like to ask, starting with you, Eric, what you think, what sort of role you would see for technology, things like artificial intelligence and machine learning, in monitoring, identifying, and addressing risks of financial stability presented by climate change.
Thank you. And I will start being maybe a little bit controversial here, that saying that climate risk is something that we, one way or the other, knows is a risk, right? It's a risk for the industries that are in transition. That might be a physical risk. So this is one of the few risks out there that we have some idea about. Just look what happened the last week. A lot of the risks that evolved in California and other places were risks that we maybe didn't know about or didn't think about properly anyway. So I think it's more generally, I think we need technology to be better to kind of track down risks for financial stability, not only climate risk, but for sure climate risk should also be there. But I think that's a kind of important frame to have around the subject, because otherwise we get kind of obsessed with climate risk and we might miss something else. No, I think then generally, I think also recent events have manifested that it's extremely hard to see where the risks are. And I think we need to basically use much more granular data, text analysis and others to actually understand what's going on. Also, again, to recent events to understand how investors are thinking. For sure, there was some strong kind of movement to take out money from the Silicon Valley Bank. Could that in one way or the other be tracked down by technology? So coming back to climate change, with better disclosure, we will be able to track down the companies that maybe face larger transition risk or physical risk. And of course, that could be a very important tool to track down climate risk that could be then a risk for financial stability. So I think that's the obvious thing. As a central banker, you also have other parts, not only financial stability. I say a few words on that, which is kind of linked to financial stability. The central bank in Sweden bought corporate bonds when the pandemic started in 2020, because basically that market almost collapsed. One idea we had at that time, or they had at that time, because I was not around at the central bank then, was to have some kind of screening so we didn't buy kind of the non-climate friendly companies. So go for the more let's say, climate friendly companies. But one of the results was that it was extremely hard to track them down, because the disclosure, but not only the disclosure, but also the ratings. I think that was seen also here in the Gaia presentation this morning, that the ratings were, I wouldn't say all over the place, but they were for sure not pointing in the same direction. So if we were ratings all are green, all are red, then we know which companies to choose, but that was not the case. We ended up doing some basic screening, but not doing the advanced screening that we. And this, I think, is a kind of an interesting observation, because this is exactly what we would like to know. You know, where are the risks for in the corporate sector or in the financial sector, and we couldn't find it out. So again, data, AI, machine learning to kind of analyze the data and to get some kind of risk picture, some kind of scenario where the or some picture where the risks are, where they not are. And then again, coming back, I think this is general, is also for other risks, not only climate risk, because I also from a political point of view, and I have some experience in that, if you are in a system like in Europe, a lot of the politicians want to be green. It's really good. But the risk is that if you do green things at the central bank or that regulate, people are applauding, saying this is really, really good. If you do something else that might be more important for financial stability, they might not. So it's also important for the integrity of central banks and regulators to actually point out that it's not only climate risks that is a risk for stability, it's a lot of other risks as well. So I think that's kind of my take on it.
Thank you very much. Eddie, may I pose the same question to you?
Sure. Well, we actually found out through our requirement for banks to measure the risk, to undertake stress tests, that when you do everything in practice, as Eric said, it's really down to one, data, and two, data analytics. And here data, we are talking about very, very granular data, because think about it. When in Hong Kong, a large part of the books of the banks is mortgages. And if you think about flooding risk, the building and the building next to you is already quite different. Typhoon risk, whether you're facing the harbor or not facing the harbor, makes a big difference. So it's actually very granular data, and the banks in Hong Kong, especially the small banks, they don't have both. So what we've been doing in the past 2 years with the banks and also some other private sector participants is to try to create two things. One is to create a common data repository, putting all the local climate data into one place. They're all there. 30 years of climate data, 40 years of flooding data, but they spread around, scattered around. It's extremely hard to find. So we get all the government departments, the relevant ones, the observatory, the drainage, the works department, to get together, talk to us, build at least a system that you can find data. But once banks get all this very granular data, what do? They can do nothing, because for the bigger banks it's easier, because they have their parent who's got sophisticated models that they can adapt for some use. But you still need to adapt them. For example, in Hong Kong, you've got more typhoons than the others. You've got more flooding because we're close to the ocean. And they still have to adapt that. The insurance companies are very good at that. They did it a little earlier because of the business that they have. So we brought the insurance companies in. We brought the climate scientists in Hong Kong in, the observatory scientists, etc. And we got a consultant to also help us think about, hey, can you build a common data analytics utility? Very much like what globally people are thinking about. But here, we're talking about a model, a utility that small banks can use in Hong Kong, so that they don't have to invest, they don't have to find the people to build the models individually. They can just take that utility model from our platform, plug in their own mortgage data, and they will know the physical risk. It will take a bit of time to build this, but once that's built, it will be of great help to the smaller banks in terms of physical risk assessment. And we are also doing a joint project together with a few central banks through the BIS Innovation Network as well, the Banque de France and also the DNB, partly because we're all low-lying. And they're also thinking about physical risk of their mortgages. So we're exchanging our experience on how to build these utility packages for the banks. And I think for a very new area like this, it will be actually the Innovation Network can serve a very useful purpose for central banks to exchange their practice, to exchange the experience, so that we don't all have to reinvent the wheel.
Thank you, Eddie. Stefan, we've talked about the ways in which central banks can use technological innovation to address issues related to climate change. But what about regulators? What role can they play when we look at the juncture between new technologies and climate-related issues?
Yeah, from the regulator's point of view, it looks a little different. In Switzerland, I guess we are, as usual, a little bit old-fashioned. We set the framework conditions. We try to prevent market failures. For sustainable finance, this means we have to walk the fine line between setting the targets in line with the international climate objectives, but also leave enough room for the market participants to then find different solutions to come to that goal. And I guess, again, specialization plays a big role. And I know we are almost running already short of time, but just to give you one example in terms of data, one example that we are following more closely is the use of artificial intelligence to make sense of satellite imagery. This is information that's widely available. It's unstructured, it's unused, and we are finding out with the people who understand this more properly that you can use this data for climate and nature space. I mean, the next frontier after climate will obviously be nature and biodiversity. So this is really a large chance and playing field that we see for AI and fintechs. But perhaps in the end, after and also listening to my colleagues here on the panel, I guess, as central bankers from the outside, you are by default, by mandate, and by DNA obsessed by stability and preventing risks. The problem with this is that mostly, and in the traditional world, this is a reaction to what's happening out there. In this new field of climate, it's like we first have to convince people that there is a risk. And if I listen to the GFAN's conversations, for example, in the US, where we talk about legal issues, if the asset managers are really doing the right thing to follow profitability, And on the other hand, if I were a pension fund, I would say, well, if I have a 30, 40-year engagement, certainly I should think about climate. But the markets are not giving us these signals now. So I guess the real task is that we have to really hurry up with all the data that it's available and convey this real message that the markets will also understand. I mean, the actual conflict in Ukraine is going the other way, with all the fossil fuels being more profitable in the short term than everything we're talking about here in this room. So I guess we really have to push forward this technological issue to convince the markets basically to push on this thing.
Well, thank you very much, Stefan. This has been a fascinating discussion. Please join me in thanking all of our panelists.